Well, this morning, as we know, the Bank of Canada kept its policy rate steady at 5% for a sixth consecutive meeting. But the bank also changed its language around inflation. It was subtle, but the last statement was worried about persistent inflation, while today's outlook took comfort that signs of inflation were easing, though they contained enough warnings that they must remain vigilant on inflation. But this does come at the same time that we got a read of inflation south of the border that came in hotter than anticipated, reducing odds even further of rate cuts. Are Canada and the U.S. on different paths? Let's bring in Eric Lascelles, Chief Economist at RBC Global Asset Management. Thanks so much for joining me.
My pleasure.
So we are seeing this uptick in inflation south of the border at the same time that inflation in Canada looks to be heading toward the bank's target, something that they acknowledge. What does this mean for who's going to cut first?
Gosh, it's a great question. And let's start by saying, theoretically, Canada has been in the better position for cutting for quite a while. The economy has been weaker right over the last 18 months or so. Inflation has usually been a little bit lower, but the Bank of Canada was very coy and wasn't communicating rate cut plans. And so the market wasn't convinced that the Bank of Canada could possibly go first. And the Fed was much more eagerly talking about rate cuts. And as you've said, now we've had something of a reversal here. And so U.S. inflation was certainly hot this morning. It's been hot, in fact, for a number of months. And so the Fed isn't in as good a position to cut. And the market is scrambling to unwind that easing right now as bond yields rise. And the Bank of Canada sidles up to the bar and talks a whole lot about rate cuts and celebrates improving inflation.
Was that a mistake by the Fed to be premature? Because to use that word celebrate, I did feel like in previous pressers, it was almost downright celebratory the way Powell was talking about inflation.
I think it caught us all a little bit by surprise just how vocal and transparent they were toward the prospect of cutting. Don't get me wrong, I do expect some rate cuts still this year. It just doesn't look like as much or quite as soon. I wouldn't want to, though, underestimate maybe some of the positive effects that have come from that. I mean, the stock market soared, maybe some economic confidence was ensured, and so perhaps there were some advantages to that strategy. But I would say in general, as a central banker, you don't want to commit too early, especially when that commitment maybe isn't quite properly there.
Well, and we should, I guess, take a look at under the hood. We're not just talking about rate cuts in isolation. Something is going on in the economies to warrant that. If they don't have to do it in the U.S., presumably it's because growth is strong. If they have to do it in Canada, it's because growth is not.
That's right. So there's been this significant growth differential between the two, though maybe narrowing a little bit recently, just as the Canadian economy perks up a little bit. And I would note the Bank of Canada actually did upgrade its 2024 growth forecast, so not diametrically different there. But as you said, the inflation path is somewhat different. And here we have a Canadian inflation rate that's sub-3, a U.S. rate that's actually been rising somewhat into the mid-3s. And I wouldn't want to overstate a half percentage point or 3/4 of a percentage point. But, you know, the momentum is different, and the Bank of Canada rightly is celebrating some of the progress that's occurred. And so, you know, June could be on the table for Canada. It looks to be almost certainly off the table for the U.S. as a start for a rate cut.
For June.
Right. And I wouldn't guarantee that whatsoever, but we had Macklem saying June's a possibility, and, you know, what needs to happen to get to that kind of outcome? It's just inflation needs to keep doing what it's doing. There was nothing additional magical that needs to happen.
On the economic data front in Canada, there's been a couple of disappointments, notwithstanding the fact that they upgraded their forecast, but also looking deeper into metrics like productivity, into GDP per capita, and calling that out as sort of a larger problem, maybe that the bank can't fix. You know, where are politicians on that? Can you give us some insight into why those metrics are getting weaker? Is immigration a part of that, just because we've accepted so many people readily and we haven't yet seen the beneficial outputs that they bring?
Yeah, so I think there's some short-term and some long-term issues for Canada's underwhelming productivity. That the short-term might be a bit of a pandemic hangover, though the U.S. doesn't seem to have much of one, to be fair. Certainly, I think there is a temporary immigration indigestion effect, and so you've intentionally attracted...
The U.S. did point a fiscal bazooka
for sure.
to paper over that.
No, you're quite right. That's right. And so some is temporarily immigration that indigestion should go away over the next year or two. There is a broader issue, though, which is just not much capex in Canadian companies, not much R&D, not very friendly business-oriented rules. And so I do think we need some more policy focus there. And of course, here we have a budget in less than a week, and maybe it'll nudge a little bit in that direction. But I think it's a slow process to recover that.
In the U.S., you mentioned you still believe in rate cuts at some point this year, maybe not starting in June. What's your conviction, I guess? Is it getting weaker by the day every time these data points come up? And what probability would you assign we don't get a rate cut at all this year?
Yeah, I was asked that question yesterday. I might have a different number today. So you're certainly right to suggest it's in motion, and these inflation numbers are not helping a whole lot for the rate cutting story. You're not going to get rate cuts if core inflation keeps clicking along at 0.3 and 0.4. That's just not sufficient. I will say, the breadth of inflation has narrowed a little bit. We do see U.S. wage growth slowing. There are a few things that are lining up in a way that suggests inflation can come down somewhat and maybe open the window to a cut. But to answer your question, I think we're maybe in the realm of about a 25% chance that there's no rate cuts this year, and that's higher than I would have given yesterday, certainly much, much higher than almost anyone would have given at the start of the year when you had 6 and 7 cuts priced in by markets.
Bond yields are selling off. Bonds are selling off. Yields are rising. We're at 4.5 on the U.S. at 10-year right now. This is around the level where maybe things start to, break a little. We've seen episodes of that with the regional banking sector. At what point do you get worried about sort of a tantrum in the bond market?
Right. And so, of course, we did touch 5 at one point. So we're not setting, recent records. But you're absolutely right. That's a big increase in yields. And all else equal, it should slow economies down and induce a bit of pain. And that is sort of half the point, which is if we're going to get this inflation under control, we do need probably a slightly slower economy. And so I would view it as being more constructive than not in terms of achieving that goal. And we're just living in a world right now where good economic data is bad. Bad economic data is still bad. We want mediocre economic data. And we've been a little bit too hot on the inflation side and maybe a little too hot on the growth side, at least in the U.S. recently as well.